Hi, I am Uday Ved, Chartered Accountant. As you all know, Union Budget 2016-17 is less than a week from now. 29th of February is when the Finance Minister, Mr. Arun Jaitley, is going to present the budget in the House of Parliament. This is the third year of the new government where this budget would be presented, and the second year, full year of the budget which Mr. Jaitley will present. The expectations of people and corporates are very high. And having said that, if one looks at the global scenario, the global economy is not doing that well. It is slowed down all over. China is not doing that great. And if one looks at India is really the bright spot from a positive perspective. There is a slowdown, but India, if reforms getting implemented in the right spirit, can really shine from here and achieve the growth, possibly double digit in a foreseeable future. Since the economy is low, expectations are high, I think the finance minister has a tough job to do, and there has to be some kind of a balance which will need to be done, having reforms, structural reforms getting announced and economy back on the growth path, but also making sure that the tax collections also match. Whereas we are all doing our P&L as businessmen, finance minister has a P&L for the country, and that's why the maths has to tally finally. So let us see what are the expectations of the corporates from this. For the first time last year, when finance minister presented the budget, he gave a path, a reform path, and he said that the corporate tax rate of 30% will be reduced to 25% over a 4-year period. A very good sign. For the first time somebody is given a path that this is how the economy is going to move, this is how you can plan your affairs. Having said that, he did say that will not be reducing the tax rate in the current year, which is financial year 2015-16, but it will be done over next 3 years in such a manner that over a 4-year it will become 25%. Would that mean that there will be a cut in the corporate tax rate this year? Logically, yes, should be about 1.5%. One would need to see what finally entails out of this. This is as far as the base rate is concerned. In terms of the surcharge, what he said was that the base rate will be reduced from 30 to 25. He was silent on the surcharge. And if one looks at including the surcharge today, the corporate tax rate is effectively 34%. So 34 has to go to 25. Surcharge may or may not be removed this year, or it may be tweaked to an extent, but over a period of time, by 4-year period, which is in 2018-19, I think the rate should be 25%. And I'll tell you the reason for that. If India wants to become competitive in a global world, if you look at the Asian countries, look at the Far East Asian countries, China is at 25%. Hong Kong is at 15%, Singapore is at 17.5%. So if one wants to be competitive, then the rate has to be 25%, including surcharge, over a 4-year period. Having said that, he did mention in the last year that whereas the corporate tax rate will be reduced from 30 to 25, it has to necessarily do away with all the incentives and deductions which are in place at this point of time. And that's why the rate will be reduced, the incentives and deductions will be phased out over a period of time, and the law becomes simple. I think it becomes easy to administer, and I think there's a merit in that. As a corollary to that, in September of 2015, the Central Board of Direct Taxes announced what is the phase out reforms of incentives and deductions, like the ATIA for tax holidays or section 35 R&D expenditure weighted deduction and few other incentives. This will be phased out. The sunset date has been put as March 31, 2017. So it's still 1.5 year down the line. And as a corollary, the tax rate also might get tweaked at that point of time, may not necessarily be this year. Whereas all the incentives and deductions are going to be phased out most probably by March 31, 2017, I think the government would need to relook at certain incentives like R&D. India wants to become the R&D hub, and if that situation, then maybe the R&D benefit, the weighted deduction might continue for some point of time, or some kind of an incentive may be introduced in the time to come. Globally, economies like UK, they have a patent box regime, taxing patent box companies only at 10%. And if India wants to be the R&D hub, increasing pattern, make in India, the startup India, the programs that government has announced, then I think R&D and patents will play a very, very important role, and that can be separately carved out. Similarly, if you want to promote exports, then special economic zones would need to be taken into consideration. So some of the incentives might be maybe prolonged a little bit further, and other incentives may be phased out in a manner that the maths add to what finance minister wants to achieve over a 4-year period. As a corollary to reducing incentives and deductions, the one thing which is missing in that note of CBDT of September 2015 is on minimum alternate tax. And if these incentives and deductions are going to be phased out, then a natural corollary would be to remove even the MAT together with that. Not necessarily now, maybe the MAT rate may be tweaked, but by 2017, the MAT also may need to be removed. Of course, for foreign companies, the government announced that the matter went into the AP Shah committee, and there is a clarity that the foreign companies are not subject to MAT, but Indian companies do pay MAT today, and that will need to be addressed. The third part, which is interesting of this government, is that the discussion does not take place from one budget to another budget. There are lots of things which happen over a period of 12 months. And last year, a number of those initiatives were taken. One such initiative was formation of the Ishwar Committee, Justice Ishwar Committee by government, to look into simplification of the income tax law. That mandate of that committee is over 1 year, so the committee is in operational, but the committee has issued a draft report which looks at simplifying and rationalizing the tax provisions. And I would believe most of the recommendations, I'd say the great job that the committee has done, most of the recommendations of this committee would be taken into consideration when the finance bill is presented. As an example, there is a huge litigation on section 14A, and I will tell you what that means. That when you borrow and invest in a company, and if the income that you receive in the form of dividends, as an example, dividend from shares is tax exempt, then the borrowings against that, the interest is not deductible. And what committee has said is that dividend is not taxed in the hands of the shareholder, but is taxed in the hands of the company. So there is an economic taxation, and such interest on the borrowing, if paid, if invested for earning this dividend income, should not be disallowed. If this one recommendation is taken, I can tell you number of the past litigation may be resolved in the time to come. There are other recommendations in terms of deferral of the ICTS, the income computation and disclosure standards, where the committee believes that India is not ready in view of various reforms happening under Companies Act or the potential GST which is going to come, and this one more confusion should not be there at this point of time. Committee has also recommended that the TDS, the tax deducted at source on individuals, should be reduced from 10 to 5%. I'm telling you, this will also have a lot of implications, and number of issues which get stuck in the tax refund for small investors will that get addressed. Faster refunds is another thing that they have suggested. Better assessment procedures. No reopening of the assessment when there is an audit objection. Today, by default, whenever there is an audit objection, the case gets reopened, and the committee said that's not necessary. So these are some of the key recommendations that the committee has made. One more on the non-resident front. Today, if a non-resident does not have a PAN number, then the withholding tax, the TDS, is 20%. And the committee has said that, look, that's not absolutely necessary. If what is necessary is that the person should be a non-resident, and if a person is able to portray and prove that he has a tax identification number, that should be sufficient. So number of this kind of initiatives, the recommendations more on the procedural front and the rationalization front which have been given, and I'm sure Ishwar Committee recommendation will be taken into consideration. The other part is the Tax Administration Reform Committee report by Dr. Shom, which also talks of procedural aspects of the tax administration, and I would believe that should be taken into consideration. On the international tax front, there is this new initiative of OECD called BEPS, the Base Erosion and Profit Shifting, which is there in terms of value creation is where the tax should be levied, is what the OECD and G20 countries have said. And India is a significant contributory to this process of BEPS initiative. not only as a participant but effectively contributing at the highest level by the Indian tax office. And one would see number of those changes on the BAPS getting implemented. As an example, on transfer pricing, a country by country report will come into should come into in the finance bill, and that will create more transparency and better risk assessment to do the tax audit or a transfer pricing audit. Also, the whole objective of BAPS is the substance over form, and one would see changes on the treaty abuse. As an example, what happens to the India-Mauritius tax treaty? What happens to the GAR, the General Anti-Avoidance Rules, which is scheduled to be inserted now from April 1, 2017? What happens to the change in the definition of place of effective management, the POEM, a tax residence new concept which has been introduced last year, and the CBDT just issued the guiding principles in December of 2015, and it will endeavor a fit case to defer the POEM by at least a year or coincide with when the GAR comes in, and similar should be the issue on CFC. One would see these changes on BAPS, and some of these changes may not necessarily be change in the act, it could be simply change in the rules, and one would see that coming on that front. Coming back to individual taxation, what's in it for me? Ultimately, at the end of the day, the common man or Aam Aadmi is saying, what's in it for me? Will there be some goodies? Will finance minister put in some more money in my pocket which can be used for further savings, investments, expenditure, etc.? Would the exemption limit be increased from 2.5 lakhs to say 3 lakhs to come in line with the inflation? Is one question. Or would there be a tweaking in the slab rate? These are the questions which finance minister will answer in this upcoming budget. Having said that, there are certain things that FM can certainly do. As an example, in case of medical reimbursement, current limit is 15,000, which was set some 15-20 years back, and that could be in line with the health costs which are going so much, could be increased to say 50,000 rupees. Children education is becoming so expensive. 100 rupees per month per annum per month is exempt. Where do you get a child to get a proper education? That could have at least tenfold increase from 100 rupees to 1,000 per month. Or that could be a hostel allowance going from 300 rupees to maybe 5 times the limit of 1,500 rupees per month. That could be done. And the last front on this is meal allowance, and I think this is very important. We have a 50 rupees per meal per day exempt in case of an employee, which is ridiculous small amount, and that needs to be increased to at least 125 150 rupees per meal, and that would, if it means that effective even after the employer gives some subsidy, that one is able to get the proper tax exemption. Similarly, there could be certain changes on the interest on bank deposit. Currently interest is exempt up to 10,000. That limit is low. If one can increase that, and it will spur more bank deposit, time deposits into the bank, and the 5-year tenure can be reduced to 3 years. Also, housing is very, very important, and there has been a demand to increase the interest on housing borrowing from which is invested for the purpose of buying a residential house. Currently the limit is 1,50,000, and if one looks at the housing cost, then certainly 1,50,000 is not sufficient, and there has been a demand to increase to at least 3 lakhs per year. And I would say last part in terms of the national pension scheme, the NPS scheme, which is very popular today, but it is an EET exempt in tax when actually one receives the final proceeds. To equate that with provident fund and other PPF regime, it could be made EEE, the exempt. I think if it does that, a lot of people will put in money in the pension scheme which was floated by government few years back. Coming back to the indirect tax, I think the biggest reform that needs to be, which is an unfinished agenda, is GST, the goods and services tax. And I think government is making huge efforts in last few months to make it effective from April 1, 2016. It's more a political opposition from Congress and other parties, and I think all parties need to come together to make sure GST is one reform which is really going to help the Indian economy grow by maybe 1 or 2% of GDP. Growth can come straight from the GST. And one of the key aspects is the Congress has been putting a demand of putting the GST rate in the constitution bill itself, which is not appropriate, and one needs to make sure that the GST reform gets passed as soon as possible. But pending GST, government can still do rationalization of some of the matters. The service Swachh Bharat tax today, which is 0.5%, can be subsumed into the larger service tax. A lot of indirect tax reforms in terms of rationalization measures can be done. Some of the moderate credit getting lost on capital goods, that can be corrected in the upcoming budget, because that is clearly within the government's regime. And finally, would there be increase of rate of service tax from 14 to 16%? If one looks at the pending GST, then I think that makes a sense. That makes sense in terms of going from 14 to 16, and then maybe 16 going to 17 or 18, whatever could be the final rate. And that could also help get more tax collection, and I think it will help from a larger perspective. If one looks at the tax collections up to January, when Revenue Secretary recently made announcement of end of January, they are at almost 88% for indirect tax and almost 2/3 for direct tax. And over a 12-month period, it looks like the tax collections will be the targets will be met for the first time in last 5 years. If that's the case, then there could be a case for reducing the corporate tax rate by 1 or 2%. Last part, the horse of the tax, there are various initiatives that government has taken. The Startup India initiative, very, very important, and Make in India initiative, and there should be tax incentives given for startup. One would expect 3-year tax holiday to be put in. Some of the issues on the ESOP getting taxed at the time of sale more than at the time of exercise to attract the right talent, and various other incentives on capital gains. If one invests into the startup, then the capital gain should be exempt, as some of the asks which are there for the startup, and startup will really grow, take India to a next level. It also falls in line with the Make in India initiative. The Make in India week which just went was a very successful week. The Digital India initiative, the skills development, putting importance to the education, very, very important. And finally, empowering women more and more. I think that's the more broad gamut of expectation that I would believe are important. The government and the finance minister should focus. This is a difficult year, and I'm sure the finance minister and his team are looking at it very closely. The destiny has already been written. We will come to know what happens on 29th February. But I would expect that this budget will be a structurally reformed budget, and it will create a lot of positivity and, more important, ease of doing business in India, which is very, very critical for India to come up the notch in terms of the foreign investment, the investment climate. Thank you. Thank you very much.